Welcome to the Private Lenders Podcast with your hosts from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey everyone, Chris and Jason here, Private Lenders Podcast. We appreciate you checking out the show. Real quick before we dive in, I wanted to mention some live events that you can discuss with our program manager, Dave Bauer. Just go to hardmoneymastermind.com, click on live events. We have one more coming up in 25 and then a couple or a few planned for 26. So go to hardmoneymastermind.com and schedule a time to talk to Dave. Okay. Lending on occupied properties, specifically tenant-occupied properties, is something we do, you can do. Depending on the situation, it could be, not much of a risk, but there are some potential downfalls and some additional trouble you might have to deal with. And so we're going to dive into a few of those examples today.
Yeah, typically the way I look at it is if we're aware that there's a tenant living there, or it's going to be a rental property and the borrower is sophisticated enough to navigate handling that, which we're going to discuss, then typically we're comfortable with that. But let's be honest, I think a lot of people they think of the ARV as the holy grail of this industry. We're ARV lenders. We only base off ARV. And keep in mind that an after repair value property, after you fully renovate a house and it's macked out and it's staged and it's put on the market, that's your ARV. But the second somebody's living in that property, they move into that property, it is decreasing in value. And knowing how much that property is going to decrease in value or what it's worth less is very hard to determine, right? If you move somebody in there now, all of a sudden, and it's a good tenant, you have a fully renovated, livable house. But then who knows what's going to happen? Are they going to destroy the property? Does it have to get re-renovated? Are they pissed off at you and then they smash holes in drywall? Or do they just have general wear and tear? So there's certainly risks that come along as soon as somebody is in that property. Trying to figure out what direction to go in as we discuss some of this, because we got a lot of different stories to share, kind of good and bad. But I'll preface it by how we started. Of if the real estate investor you're lending to is sophisticated and has experience in that local area, they know the jurisdiction, they know the city, you trust that they're going to be able to navigate everything good and bad, then we're typically comfortable with them. I mean, there's deals that we've done where real estate investors will buy properties sight unseen from an auction with a squatter or a previous owner or tenant in that property. And we're even comfortable lending to them because their level of sophistication and the amount of down payment they're putting up. Right. Well, we can start with that. Chris, I think, wants to chime in on some stuff, and then we'll go through some other things.
Yeah, that was one example I hadn't even thought of, but we have definitely won deals in the past because a lot of lenders, especially institutional, they won't be able to do the loan if they can't get interior access prior to closing. But we can, if we just assume that, the purchase price in the neighborhood of the as-is value and even maybe discount it from there, and the borrower being sophisticated will be comfortable with it. And so we've won deals there. But let's talk about a more common example real quick. I guess we'll start more in underwriting phase and then we'll move down to some default and some other, messy stuff. But it is very common to get loan applications where the real estate investor is buying a property that they intend to keep as a rental, right? The BRRRR method, very common. So these can be done. They use lenders like us to acquire and rehab the property. And then the plan is to put a tenant in there, refinance with a 30-year DSCR loan. We get paid off and great.
Yep.
The thing to look out for is really underwriting the income, because it's going to need to cover what that end payment is, like what's the market rent for this property. And then also the borrower's financials are going to be more important in this case than in a flip. They're important in both cases. But in this one, you have to depend on an institutional long-term refi, permanent debt, to pay you off. And it's very easy for a borrower to say, oh yeah, no problem, I'll just refi to pay you off. It's easy to say that sentence, and people say it all the time. Whether or not they're actually going to qualify 6 months from now is a different story. So one, this is where a situation where knowing their credit, pulling credit, is very important, because there are credit requirements for a DSCR loan. Their finances in general, right? How much cash are they working with? Do they own other properties? And some real estate investors are very good operators in this capacity, and you can do these loans and you will get paid off. And then some other people aren't going to qualify for that takeout financing. And so being able to tell the difference, it's not going to be guaranteed, but looking at a file and being comfortable enough to be like, all right, this one will qualify, this one won't, is an important skill if you're doing this kind of lending.
Yeah, because if, for instance, they can't refinance, either they don't qualify to refinance, or you're in an area like Baltimore City recently where they've stopped doing DSCR financing, and they have a tenant in the property, and the owner's like, well, it doesn't support the debt at your 13% interest rate. Like, this is a losing battle. Then you're stuck. And we've, it's interesting because we've been aware of a lot of, issues in the past where real estate investors are stuck and they get themselves in trouble. And I don't want to say it doesn't affect us, because I'm going to go through 3 or 4 case studies here in a second, which it does. It has. But if you're lending with high enough down payments to the right borrowers, they're going to figure out a way to get out of it, right? Because, you're lending, 130 on a 200 as is, or something like that, right? Like they've set, they have enough equity in the thing. They're not just going to walk away from that. But if you're giving them 100% leverage or 90% leverage, or maybe even 80% leverage on something like that, and, there's nothing left for them to they're not incentivized to get out of the deal, they're just going to walk. And, that's challenging. So, okay. So let's talk about a few kind of scenarios that I think a lot of, especially newer lenders, might not have come across yet. I think that's a standard one. And I think most people think about it that way. Like, what happens if you can't refinance the property? What's going to end up happening? But here's some real scenarios that have happened. So we were in a deal where a borrower fully renovated a house. They went to fully renovate the house. They went to sell it. They realized they couldn't sell it at the price that they wanted to sell it at. They're like, shit, like this thing's worth a lot less than I thought. I can't make any money on this thing, right? I can't make a lot of money on this thing. I'm just going to go put a tenant in there, right? That doesn't mean that like we're in a bad spot at our loan amount, right? But that just means that they're not making any money on that. Let's just put a tenant in there instead. Let's wait till the market gets better in 6 months, right? Like that's their thought process. Let's just wait till the market gets better. Well, as soon as you put that tenant in the property, if you had a property that was probably worth 300 grand, you listed it for 350, you lowered it to 330. You're like, oh shit, if I sell it for 300, which is what it's actually, HMB told me it's worth, I'm not going to make any money. I'm just going to put a tenant in there, and it's going to be worth, 350, 6 months, right? Because real estate always goes up in value. So they think. And then all of a sudden the tenant's in there, and the tenant tears up the house. Wear and tear. I'm not even talking about a malicious tenant. Best case scenario, it's wear and tear. And then they go to list the house. They either got to put more money to re-renovate it, or they're a nice livable house. So like think through that scenario, right? That's not a good scenario. You need to advise your clients to not allow that to happen.
Yeah. I know you have a few examples, and I was thinking of a couple too, in which we've dealt with tenants that we didn't think that we had to. I'm going to go through one that's a little gnarly, and then we can get into some other stuff you have on your list. So there's one that we currently own, and here's what happened on this one. We had 2 properties as collateral. One was just additional collateral, I believe, and the subject property was fix and flip, or so we thought at the beginning. So we did the loan. It had a rehab component to it. They did the construction work. We dispersed the funds, and then they put a tenant in there and went under contract with a lease to own. We didn't know this was going to happen. We thought it was going to be selling on the market, vacant, like normal. So they put a lease to own tenant in there. Some time went by. This tenant isn't qualified to buy the house, right? They can't qualify for the mortgage loan for the price. The borrower defaults. We take it back at foreclosure auction. It doesn't sell, it sends back to us. And now we have a tenant in there who's not paying any rent that we didn't plan was going to be there. And so now we're in eviction court. We have to evict the tenant so that we can sell the property. We know that it was in pretty good condition when we did our last draw, but what's it look like now, right? This is like a year plus later. And so here in the near future, the tenant will be moved out, and we will get in there and, secure the property, list it for sale. is just a whole scenario that we didn't anticipate having to deal with, right?
Yeah.
And also, depending on the state you're in, the jurisdiction where you lend, evictions could be really challenging. In some places it's easy, and in other places it's can be contested for a long period of time. We're in a couple of those markets actually. So something to consider.
Yeah. So another scenario, 2-unit deal in Baltimore. We did a loan for a repeat borrower, good repeat borrower. We had cross collateral on another property. He ended up getting behind on some payments. The plan was, I don't remember what his exact plan was, but he paid off the cross collateral. It reduced our loan amount on the subject property, which was nice. And he got far behind payments. And he didn't necessarily say, and he's got 2 units. It's a 2-unit property, and the tenants were paying rent, then they stopped paying rent. And where it was in Baltimore is the eviction process is a nightmare. It's a pain in the neck. Like, he wasn't getting rent. He couldn't fight for it ever since COVID. A lot of, it's just hard to remove tenants from properties. So he didn't necessarily like throw it at us and say it's your problem now, but he did. But in essence, it was like, I'm not getting rent from these guys. I can't pay rent anymore. I'm broke. You go to foreclosure, right? So we went to foreclosure sale. It didn't sell at auction, even though the price was right, and we're at a we're at a good number. We're still at a really good number. It didn't sell at auction because there wasn't that many people at auction, but more importantly, like they didn't know what was going on. They didn't know the scenario. It was occupied. It was challenging. So we decided to list it with a real estate agent. And I told the real estate agent, I was like, listen, the tenant's not paying rent. I don't know if they're still there. They're not there. They're not paying rent. You need someone, potentially a potential buyer is somebody who wants to live in one unit, rent out the other one, or just, have a rental property at a good price. Like, we're not going in there and spending time to evict them. Like, we're going to sell it at a really good price to somebody that just wants to deal with that problem. And that's what we did. And that ended up working out. But I recall talking to another lender in a group that had the same situation, and they had, because the loan amount, their LTV was too high, they had to throw good money at bad money because they couldn't just walk away. They couldn't sell it at a low enough value to get out of the deal, right? They needed to go in. They had to go through the whole eviction process. They had to get the tenant out of there. Then they had to go and they had to get it into some sort of condition to either sell it to an investor or a homeowner. So it's important to make sure that you're aware of some of these scenarios, but also that your LTV is low enough that when stuff like this happens, because it does happen. This particular borrower, we did 6 successful deals for. And on his 7th deal, things fell apart. And without changing subjects, we've also learned from being in this business for 18 years that every relationship comes to an end at some point. We did 50 loans for a real estate investor, and his 51st, he defaulted and fled the country and, rolled out.
True.
And we got stuck with a freaking thing. We did 50 loans for the guy. You don't think that after you do 50 loans from somebody, I think most people listening to this, every time that you do more and more deals from somebody, they're not going to try to beat you up for better terms and higher leverage and things like that. Well, at some point, it falls apart. So you got to be strong and you got to stick to it. And I know it's tempting sometimes, but things happen. And this particular deal, we did 5 or 6 successful deals, and we weren't any more aggressive with this borrower. Don't get me wrong. But this was the one that ended up happening where, the guy had other unforeseen issues and it brought him down. And he was like, I'm not making any money on this deal. I'm not trying to screw you guys. I'll help you any way I can, but I can't make payments anymore. And eventually we had to foreclose.
Yeah. I mean, if you do enough loans, you're going to see all of these scenarios. And as more lenders in the Mastermind group get further into their lending careers in this business, they're starting to see this. They're seeing the regular foreclosure, they're seeing some tenant-occupied stuff, some fire damage. If you do enough deals, you'll see it all. And so that's why we like to. Did you have another example?
Yeah, I got one more example we can end with.
Yeah, jump in with that.
Okay. Yeah. So, one more example. We're still in the middle of this right now. It's a 5-unit building that we're involved in. And keep in mind, multifamily has more risk than single family in this space. And the reason why is multifamily properties only get sold to investors. They don't get sold to homeowners. Single family properties get sold to homeowners and potentially investors as well. So this particular deal that we're still in the middle of, we did a 40 LTV deal at the beginning. they're in a bad market, or not bad market. They're in a bad jurisdiction where all 5 tenants or 4 of the 5 tenants are not paying rent. And we're taking this thing to foreclosure sale. They're fighting it. They don't want to lose the property. I don't know why they don't want to lose the property. They're not getting rent from it anyways. They're trying to sell it on their own. But in essence, we're going to see what happens. Like, we're either going to have to take back the property and, we're at a low enough LTV, we can sell it to an investor. But like, if we were at a high enough LTV where we couldn't get out, we would have to go do the heavy lifting. And most people in the mastermind group, including ourselves, did not get into private lending as an acquisition strategy. We're not trying to get into these deals in order to have a real estate investment side of it, right? Because the deals are, low enough that you'd be like, oh, I'll take back this property and hey, I'll make a fortune. It's not going to happen. It doesn't typically end up like this. So the ones that, you would be taking back would usually be the ones that have a little bit of hair on the deal. So we're still in a comfortable situation. When I say hair, we're good on LTV. The hair is, do you fire sale to a real estate investor that's going to deal with it? Or are you going to go and put man hours into evicting some of these tenants, getting it stabilized so you can sell it back at top dollar?
So whatever the sideways situation is, I would, like I started to say before, if you do enough deals, you're going to see all these situations, and getting some good advice to help you through it is exactly what the mastermind is for. I would recommend, if you do get into a sideways situation you haven't dealt with before, throw it in the mastermind group. You'll get comments from us and other people on what we would do in that scenario. And hopefully that is a lot of value, brings a lot of value in terms of what your exit numbers are going to be. Hopefully your defaults are profitable. Hopefully lending's going great.
Yeah. One more thing to note, which we did not discuss, but I'm sure you can imagine, is what happens if the actual real estate investor turns this house into their primary residence, because they go to flip the house, they can't sell it, and they say, hey, I can't sell the property at the price. I'm going to lose money. I'm just going to go move into this house. I stop paying hard money bankers because I'm in default and I'm going to lose money on this thing. Hey, I'm just going to go move into this house instead and not pay them and have a free mortgage, and they can go foreclose on me. And then I'm going to claim that it's a primary, right? We've been through all that as well. And obviously we're all doing, commercial purpose, investment property, doc sets with affidavits and things like that. So, related to, curing these situations and, going after them and getting like all that's fine. Like, we can handle all that stuff. It's the pain in the ass part of it. That's the issue, where you don't want to get yourself in a situation where when something like that's going to happen. And a lot of this is layered back to sophistication. I know we started with that, but a sophisticated borrower with lots of skin in the deal typically makes strong decisions.
All right, everyone. I think we can wrap on that one. That is the pod for today. We'll see everyone inside the mastermind group and here next time in the Private Lenders Podcast.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not intended for legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you would spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard money lenders.